Okay, let's unpack this. We're diving deep into the latest financial results for Ark Restaurants, that's ARKR, covering their fourth quarter and the full fiscal year 2025.
Yeah, this wasn't your standard earnings call.
Not at all.
It wasn't about seasonal menu shifts or supply chain issues. This was a really crucial high-stakes moment for a company that seems to be in a major transition.
Right, from just running restaurants to something else entirely.
Exactly. The whole theme was less about, the hospitality grind and more about these complex legal battles and some really speculative strategic moves.
It felt more like a special situations call than a casual dining update.
It really did. Like the future of this company is being decided in courtrooms, not kitchens.
And the market's reaction, well, it mirrored that complexity, didn't it? We saw some crazy intraday volatility, but the stock ultimately closed lower.
It did.
Yeah.
And that signals some clear investor discomfort, even though management was trying to put a positive spin on things. It's just a classic case of uncertainty overwhelming everything else.
When the numbers swing this hard, caution is probably the right move.
Yeah, for sure.
So let's run through that snapshot so you know exactly what we're dealing with. Revenue came in at $37.323 million.
Which is a pretty significant year-over-year reported decline, about 14.0%.
And that's not even the whole story. Even if you clean it up, exclude the units they sold or closed, revenue was still down 9.7% on a like-for-like basis.
And that operational weakness, it just hammered the bottom line. GAAP EPS was a net loss of 53 cents.
So a net loss of almost $1.92 million. But the real alarm bell for me was the adjusted EBITDA.
Oh, absolutely. It swung completely negative, minus $1.071 million. Last year, they were in the positive. This quarter, they were just burning cash operationally.
The swing is just brutal, and you can see the cause right in the engine room. Same-store sales, excluding those closed units, they plummeted 10.1% for the quarter.
And that 10.1% drop, that's why the stock finished lower. It sends a really undeniable message to investors.
What's the message?
That the core cash flow is declining. And when you pair that with all these non-cash charges, investors are they're prioritizing the immediate uncertainty over any of management's talk about future upside. They're applying a massive uncertainty discount here.
Okay, so let's unpack why those numbers look so rough. Management pinned pretty much all of it on one specific issue.
Right. The ongoing legal dispute over the Bryant Park leases in New York City.
And they didn't just point a finger, they actually put numbers to it. The direct legal expense was what, over $400,000 in the quarter alone?
In the quarter alone. But the true cost, the real hit, was the indirect operational one.
The events business.
Exactly. Management said the uncertainty around the leases just completely choked their higher margin events business at Bryant Park Grill. They said it cost them almost another $2 million in revenue for the full fiscal year.
That $2 million is basically an uncertainty tax applied right to their best revenue stream. Nobody's booking a $50,000 wedding a year out if the venue might get shut down.
And we really can't overstate how important this location is. The Bryant Park Grill and the porch, they're not some fringe assets. They accounted for roughly 15.4% of the company's entire FY25 revenue.
15%? Wow.
Yeah, that's $25.5 million. So this one legal battle is directly hitting a massive chunk of their ability to generate cash.
So what's the plan?
Well, management said they're pursuing all available options, but they also had to admit the outcome is, unpredictable.
So while New York was fighting this incredibly expensive legal battle, what was happening everywhere else? Was it a mixed bag?
A very mixed bag. There were definite pockets of resilience, which is interesting.
Okay, like where?
Management specifically called out improvements in cash flow in Las Vegas, which is pretty remarkable because overall Vegas Strip traffic has been reported as softer.
And they said why?
They did. They attributed the Vegas turnaround explicitly to new, strong local management. They also noted that Robert in New York and Rustic Inn in Florida actually outperformed the prior year.
So they have a playbook for a turnaround sitting right there in Vegas, but they're still weak elsewhere.
Right. D.C., especially that massive Sequoia property, is still really difficult. The catering and events part specifically.
And Florida.
Florida properties are also seeing this consistent revenue deterioration, somewhere between 5 and 7% down. Management is kind of chalking that up to a broader Southern Florida market softness.
Okay, so let's connect this to the balance sheet because there's a paradox here. They closed the year with $11.324 million in cash.
Which comfortably exceeds their total debt of just $3.6 million. That cash cushion is enormous for a company this size.
So that's the critical question, right? If the balance sheet is that healthy, why did the stock still drop? Why is the market so skeptical?
It's because the full fiscal year included these substantial, really negative non-cash items. And those signal a fundamental deterioration in the quality of their assets. It makes the market see that cash is a necessary shield, not as, dry powder for growth.
What were those items specifically?
Okay, so they took a $3.440 million goodwill impairment charge and a $4.799 million deferred tax valuation allowance.
Okay, for anyone who might not have their financial dictionary handy, break those down. What does a goodwill impairment really signal?
Think of it this way. When Ark buys a restaurant, they pay more than just the value of the tables and chairs. That extra amount is called goodwill. It's for the brand, future profits, that kind of thing.
Right.
This $3.44 million impairment is basically management admitting that those assets are just not generating the profits they thought they would. It's an admission that the core business is worth less than they previously said.
And the deferred tax allowance, what's that about?
Well, that's management signaling. They believe they might not generate enough taxable income in the future to actually use the tax breaks they've been banking. It's a very conservative accounting move, but it's also very telling. It suggests some real doubt about long-term profitability.
So these charges are what's scaring the market. It's not just a tough quarter or a legal fight. It suggests there's something deeper going on.
Exactly. It points to potential internal rot.
Given all that short-term pain, it makes sense why management spent so much time pivoting the discussion to something else.
To the huge long-term speculative bet.
The Meadowlands Racetrack Casino. This is where it gets really interesting.
This is the high-risk, high-reward, asymmetric opportunity that the whole thesis hinges on for a lot of people. ARKR has already invested over $5.2 million into this.
And they outlined a potential path forward.
They did. It requires a New Jersey constitutional referendum, which they're targeting for November 2026. If that passes, they're talking about a super ambitious timeline.
Oh, ambitious.
A temporary casino facility in 2027 and a permanent build-out by 2028.
And the CEO basically framed this as a reaction to competition from New York.
Yeah, he did. He explicitly linked the timeline to the recent approval of 3 downstate New York casino licenses. The argument is that New York moving clears the political path for New Jersey to protect its own tax base.
But this whole strategy, this was the real flashpoint of the entire call.
Oh, absolutely. The Q&A session was fascinating. It got highly contentious. A really persistent shareholder just challenged the entire core strategy.
The gloves really came off.
They did. The shareholder basically called the Meadowlands Casino a Hail Mary.
Ouch.
Yeah, and they cited 2 big setbacks. Ark, losing Hard Rock as a partner, and the new deep-pocketed competition that just got licensed in Queens, New York.
Which makes the Meadowlands opportunity a lot less valuable than it was a few years ago.
That was the argument. But the CEO, he pushed back hard. He argued that the demographics of northern New Jersey are just so compelling that it doesn't matter.
A huge, affluent, underserved market.
That's his point. And he seemed confident they could find a new operating partner, maybe even on better terms than they had with Hard Rock.
But the shareholder didn't stop there.
Not at all. They hammered management on the lack of a coherent strategy for the core restaurant business. They pointed to the shrinking footprint selling Tampa, closing El Rio Grande.
And then they asked that really stinging question.
The killer question. If you have a successful blueprint right there in Vegas with your new manager, why wasn't that person given a bigger role to fix the bleeding assets in Florida and D.C.?
That must have hit a nerve. It points right to an execution failure that's completely within their control.
It did. And management's rebuttal was, well, it focused on external pressures. They admitted they waited too long to raise prices to offset costs. They said they're looking for new deals, but things are falling apart in due diligence. It's just a tough environment.
And the CEO ended by saying what?
He concluded by just asserting that the stock is trading at a ridiculous valuation compared to their cash in the core business. You could just feel the frustration.
A really charged moment. Management's confidence versus the cold, hard reality of the stock chart.
For sure.
All right, time for our final segment. And just a reminder, this is analysis, not financial advice. We're pitching an outrageous but plausible trade idea based purely on the details from this call.
And the core conflict here is pretty clear. It's the massive uncertainty of the New York litigation versus what management sees as deep intrinsic value.
The balance sheet is strong. They think the assets are cheap.
Right. But the single biggest overhang is that draining, distracting Bryant Park fight.
So the trade has to be a bet that they can resolve that distraction and do it quickly.
Precisely. So the trade pitch here is to go long, betting on an imminent settlement or a favorable court resolution of the Bryant Park litigation,
Yeah.
maybe within the next 6 months.
And why is that plausible? I mean, the legal system can be incredibly slow.
The plausibility rests on management's own math. They said the cash flow still coming out of Bryant Park covers the litigation costs. So the primary drag isn't solvency, it's the uncertainty.
The uncertainty that killed that $2 million events business.
Exactly. And it's consuming so much management time. So resolving the case, whether they win or just settle on good terms, it removes that single largest overhang. That allows the market to re-rate the assets, stabilize the core cash flow, and finally assign some kind of positive value to the Meadowlands casino option.
Which right now feels like it's valued at 0.
Or less. So the trade is a bet that the cost of fighting has finally gotten too high and a favorable end is near.
So what does this all mean then? Ark Restaurants today is less a restaurant operator and more of a holding company.
A holding company fighting two huge battles at the same time. A legal fight in New York and a political fight in New Jersey.
So the key takeaway for you listening is what?
It's this. Can those pockets of efficiency, like that proven turnaround in Vegas, be scaled across the struggling DC and Florida properties fast enough to stabilize their cash flows? Or will the cost and distraction of that Bryant Park fight just erode their cash cushion before the Meadowlands casino option even gets a vote in 2026?
It's a race then. The balance sheet cushion versus their execution risk.
Right. That's the dilemma that defines the stock today.
A dilemma where management is adamant the stock is ridiculously cheap.
Exactly. And that brings us to the final thought. Given that dramatic pushback from the shareholder and the CEO's strong assertion of deep undervaluation, the real question is this. Does the apparent lack of insider buying a point raised directly in the Q&A signal a lack of management conviction in their own assessment? Or is it just a tacit acceptance that the stock is just too illiquid for them to buy without crushing the price even more?
The market sees that lack of insider action as the ultimate counterpoint to the CEO's confidence.
It's the action, or lack thereof, that speaks louder than words on an earnings call.